Bank of Canada Governor Tiff Macklem and U.S. Federal Reserve Chair Jerome Powell delivering back-to-back interest rate announcements, with the U.S. Fed cutting its key lending rate, while Canada held steady at the 2.25% rate set in September. What do the same-day announcements say about the state of both economies? Amanda Lang is CTV News' chief financial correspondent. Hi, Amanda. Great to see you as always. Thanks for making the time.
Pleasure.
I'll start on the Canadian bank's decision. A, were you surprised at all to see it hold the line? And B, what do you attribute to the decision?
So no surprise at all, and in fact, economists were almost unanimous this time out. And the bank has signaled, Vashi, that they feel like they're in a good place. They repeated what they said last time, which is they think they're in a sweet spot when it comes to inflation. And then, of course, we've had this economic data that was surprisingly strong, right? The 180,000 jobs created and the revisions going back 3 years saying our economy has done better than we thought and productivity was better than we thought. All of that not only bolstered the case not to move. Some economists said to me today, maybe they actually cut too much. Maybe they were thinking the economy was weaker than it was.
And what do you think that says for the medium to long term? Or maybe I'll be more specific, just the medium term, because we've talked a lot about the impact of uncertainty, and there has been an impact to that. What do you think it means for rates, for example, into the new year?
The bank, I believe, is really trying to signal that barring any massive event, it is staying here. So if you're a business and you're wondering about your borrowing rates, if you're a mortgage holder thinking to refinance, this is what you're going to deal with. Now, barring any unforeseen events. So there could be, of course, some cataclysmic trade issue that sends our economy into a tailspin. Our economy and the businesses inside our economy have been so resilient, and I think we'll agree, surprisingly so. We've actually seen an adjustment. We've seen our domestic economy stay much stronger than we thought. So while exports are super important, our domestic economy has done okay, and it's protected from all of this. And my guess is the bank is trying to say, look, we're staying here. A lot of economists, Vashi, are saying this is the level until rates go up. And some of them think that could happen towards the end of 2026. Some think it won't even happen until 2027. But that down is over unless there's some kind of real reason like a recession to do it.
Which I guess you can't count out given all the uncertainty around CUSMA and what happens next year. So, speaking of CUSMA, south of the border, the Fed has decided to cut for a third consecutive time, though because of the difference in the way they report things, we know there was some disagreement about that decision as well. What do you read into it?
Yeah, I mean, the Fed has a different mandate than our bank. Our bank's mandate is purely on inflation and price stability. The Fed does have a growth mandate. They need to look at the jobs market. There are concerns being expressed about job creation. That economy has also done better than you might fear in terms of how it's reacted to all of the tariffs, because, of course, tariffs are paid by the American consumer at the end of the day. And so we've seen either it's a delayed reaction or it won't be as bad as sort of the worst case scenarios. Vashi. Either way, the Fed's walking a different line, which is it wants to juice their economy enough. They're worried about inflation, but they're less worried. They're more worried about the downside risks to everything that's happening. And you saw that in the massive bailout that the Trump administration is giving to farmers. I mean, this is showing up already. It's hurting parts of the American economy in a serious way. The Fed has its eye on all of that.
Do you think that hurt will amplify as time goes on?
It very well might, and I just want to frame this in that would be nothing to celebrate, right? Our economy is so still closely tied to the U.S. economy that we should all be rooting for it to not be scarred by the trade wars. It's hard, though, in any kind of economic theory to see a scenario where it's not hurt. These are artificial barriers to trade. They create price pressure inside the domestic economy. It is, though, that it's being offset a little bit by this inflow of capital from businesses which are promising, at least, whether they're doing it yet, to bring capital to the U.S. and build there. It's not a job-creating kind of scenario, however. None of that capital is particularly job-creating. And so that's where, again, back to the Fed, they're worried about jobs. Jobs may suffer almost no matter what. Even if the U.S. economy does okay, you still may not see great job creation in that economy.
Okay, I'll leave it there. Amanda, appreciate it as always. Thank you.
Great to talk.